Today we're going to show you how to become a real estate millionaire with these 5 principles in the power of real estate. Lucas Walls and Bryan Schroeder here with FasterFreedom. Today we're going to talk to you about the power of real estate. When we think of the power of real estate, we think of 5 main things. Bryan, you want to talk about those?
Yeah, I'll list them off here real quick. Number 1 is leverage. Leverage is super powerful. Number 2 is compounding. Number 3 is cash flow. Number 4 is control, having control of that property. Number 5 is tax benefits. And then we're going to dig into each one of these in much more detail here in just a minute.
So the first main principle that we're going to talk about in the power of real estate is leverage. When you hear that word, Bryan, what does leverage mean to you in real estate? Leverage
means just being able to put a loan against the property. If you go out and buy a house for $100,000, if you just the old-fashioned way, you could put 20% down and get an 80% loan on the house. That's 80% leverage. With the Bird method, we know how to do 100% leverage.
We do. When I think of leverage in real estate, we're able to buy 100% of an asset with a small amount of down payment, if any. So if you wanted to go in a different investment route, say buy a stock, you can't get a loan usually to buy a stock.
Or if you could, it's very minimal.
Yes.
You can't do 100% or even 80%, anywhere near that.
Right, so a lot of times investment properties, you need 20% down to buy 100% of the asset. But we're going to teach you some ways that you don't even need 20% down.
The Bird method is freaking powerful. You can get 100% leverage, which makes your returns infinite. Because if you have none of your own money into it and you get a great return, that's infinite potential.
Yes.
Lucas, once you get your portfolio up and going, I know we both use as much leverage as we can with buy houses.
Yes.
But what's your long-term goal with leverage? Are you wanting to pay off your houses or keep them at a certain LTV, like keep that leverage and keep refinancing back out, or what do you like to do?
That's a great question. I think you and I are both at different stages of our investment careers, so we're still in growth mode. So right now we want to stay about 75% loan to value with creating as much cash flow as possible. So our current portfolio is worth about $8 million, so we want to have about a $6 million loan on it. But we want those loan terms to be the best loan terms as possible. 4.5% spread over 30 years. That's good leverage. There's a difference between good debt and bad debt.
What about you? I love that though. Keeping your LTVs around 75%. Keeping your loans as low as possible, and in the interest rate environment we got now, under sub 5%.
Yep.
And if you're getting a return on your investment of I don't know, 8, 10, 12% would be my guess on your cash flow plus your appreciation, maybe more than that, honestly. You're really you're doing the arbitrage where you're getting a higher return than you're paying for your leverage.
Yep. So with your investment strategy, how did you use leverage to build your portfolio now that it's mature? How are you utilizing leverage to get to your ultimate goal?
That's a great question, Lucas. And I used the Bird method when I was building my portfolio, and with that I used 100% leverage. And you know why? Because I didn't have any freaking money to put down. When I started this, I had a little bit of money in the bank, but I could put 10% or 20% down on one house and I'd be done.
Yeah, so for about a year or two until
you saved up for the next one. And that plan was way too slow for me, so I did the Bird method. I did 100% leverage at the beginning to buy the houses, to build up the portfolio. As soon as I could, I tried to keep my overall portfolio in that 75 to 80% range, and then I got it to the size that I wanted, which for me was 150 properties. And then I started reducing my leverage because you built up what the size you wanted. It's still good to have some leverage depending on what you want, but reducing that leverage reduces your risk too in case something crazy happens or whatever.
Reduces risk and increases cash flow.
Yes.
Yep.
Yes.
It just gives you a lot of flexibility with what to do with some paid off properties.
For sure.
So how many houses you got paid off right now?
59.
Awesome, man. That's sweet.
It is sweet.
Yeah. Leverage is powerful.
Leverage is freaking powerful. We're going to talk about compounding today. I heard a quote from Albert Einstein one time. That I'm not 100% sure this is exactly accurate, but the power of compounding is one of the most powerful forces in universe.
Wow. Yeah, that is powerful. That is powerful. And it's one of the 5 powers of real estate that we're here to talk to you guys about today.
It is. And if you combine the power of compounding with principal pay down, because if you got a house and you got a loan on it, you're paying down principal every month just in your monthly payments.
Exactly, exactly. And we got a little chart here to kind of demonstrate that for you guys. Brian, do you want to talk about some of the assumptions that you have in your chart?
Yeah, it's super easy here. This is so in the St. Louis area, which is where we're at. I use this because Sam and Lucas just bought a house a couple years ago that was using these numbers. The house, they bought it using the BRRRR method, created value using the BRRRR method, so they had none of their own money into the deal, but on day one, in the beginning, the value of the house was $125,000 and had a loan on it of $100. That's after they created value using the BRRRR method, which gave them, they forced 25 grand worth of equity into that deal at the beginning.
Yeah, right when we owned it. So numbers wise on that, we bought it for $75,000 and put about $25,000 worth of rehab and forced $25,000 worth of equity because the house was worth $125,000 when we're finished.
Powerful start.
Very powerful.
But then you guys put a tenant in the house.
That is just year one. So then we put a
Yes.
tenant in the house.
And that tenant is paying the mortgage down. You're just maintaining the house.
Yeah.
This is the power of what happens after the BRRRR method.
Yes.
So let's just run through this. The assumption in the power of compounding in here is the value is going up at a 4% annual rate. That's the assumption I got built in here. And if you go back to the history of residential real estate, I think that's generally true, about 4% per year.
Right. In the real estate world, we call that appreciation.
Awesome. So beginning it's worth $125,000. After 5 years, it's worth $152,000. After 10 years, it's worth $185,000. After 15 years, it's worth $225,000. And that's just that's assuming that houses appreciate on average a 4% per year, which is historically they have.
Right. Let's talk about what the loan does during that time.
Yeah, this is also super exciting because every month when they make your tenant makes your payment, your loan value goes down. Mm-hmm. And so if you start with a loan of $100,000, this is assuming you got a 20-year amortization mortgage on the house. After 5 years, your loan is down to $84,000. After 10 years, it's down to $63,000. And after 15 years, it's down to $37,000. So the value of the house is going up. The loan is going down just by you having a tenant in there making their monthly payments.
Exactly. And look at this final number here. If your value is at $225,000 at the end of 15 years and your loan balance is down to $37,000, you will have $188,000 worth of equity on this one rental house.
Holy shit, is that a lot of equity?
That is a lot of equity.
In one house?
One house.
What if you had 10 houses,
Oh
Lucas?
my goodness. How much equity do you have then? About 1.88 million?
That's right.
Yes, I did my math correctly this time.
Dude, that's only 10 houses.
That's
What if you
only
have
10
20 houses?
20 houses, double that, so about 3.9-ish million.
That's a lot of freaking equity. So, can you imagine how that compares to somebody going to work? Let's say you had an engineering job.
I did.
A typical engineer maybe makes 80 grand a year, I don't know, I'm just guessing.
Yeah.
And puts 10% of their income into a 401k for 15 years.
Right.
I didn't run the numbers, I need to do that, but I bet it's not anywhere close to.
It's not. And the thing about that is you're putting your own cash into that investment.
That's so true.
Yeah.
So the next piece we want to talk about is cash flow. So the great thing about real estate is you can put a tenant in the house and charge rent, which is that rent is hopefully bigger than your mortgage payment, your insurance, and your taxes, and your maintenance, and your property management fee and vacancy. Add all those up, hopefully you're cash flowing. And make sure every time you do this, especially if you're doing the BRRRR method and you use 100% leverage, make sure that after all those things, you still are positive cash flow. Hopefully at least $100 a month.
Yeah, for our multifamily investments, we shoot for $100 a door per month. Positive cash flow after all expenses. For our single family houses, we like to be up closer to that $200 a month per door for that type of investment.
Yeah, it's such a powerful thing with real estate is cash flow, because look at a different asset class like gold. Do you get any cash flow out of gold?
No, probably
no?
not. Yeah. Or if you think of a type of dividend producing stock that you buy. So you have to pay 100% of value cash to buy that stock, and they're probably giving you a 2% yield on that. So you get a dividend check every quarter, but it's not the same, and it's not even close to actual cash flow in your pocket every month.
Yeah, another thing I like about cash flow is you have some control over it. You can raise your rents if possible. Yep. You can manage your tenants. You can make the house a little bit nicer to increase your rent if you need to. If for whatever reason the house is sitting vacant, you need to reduce the rent just a little bit to get it occupied. There's choices in there. You got a little bit of control over that cash flow.
Yeah, you also have control of your cash flow with the terms of your loan. So you have more cash flow if you have a lower interest rate, or you have more cash flow if you have a longer amortization term.
Oh, those are so super powerful. I'm glad you brought that up, Lucas. So you the lower the interest rate, the more the cash flow.
Yep.
And fortunately, we live in times right now where interest rates are pretty low.
That helps, yes.
Helps a lot. That's one of the powerful things about real estate in today's world.
Absolutely.
And then the other thing you mentioned is your amortization period. So like if you go to a mortgage broker, they're probably going to put it on a 30-year amortization, maybe a 15, but 30 or 15 is the typical. If you go to a local bank, which is what we primarily use, most local banks like to put it on a 20-year am, but we always ask for 25 typically, and they'll typically do it. So they might even go to 30 if you really have a great relationship with them.
Right.
And the longer you extend that amortization period, the better your cash flow is today.
Yep. We talked about this a little bit, but we do have some control over what cash flow that we bring in every month. So that's one of the fourth benefit of real estate, the power of real estate that we'd like to talk about next.
Control?
Control!
I love it.
Yes.
Next, number 4, right, is control. So let's talk about control a little bit. So one of the things, I'll just get this started, Lucas, you can control the real estate much better than other asset classes. Number 1 is you can go look at it. You can, decide if you want to update the house or maybe change a floor plan, or can you think of any ways that you've changed your properties?
Yeah, so we're talking about control, I guess, from a physical standpoint, but there's so many ways you control the value of the property and the amount of money that property makes you. The first stage of the property is you purchase it, hopefully at a discount, rehab the property, and create equity out of thin air. That is control over your investment. And then if you turn that into, or you can sell it and create a quick influx of cash. But if you turn that property into a rental property, you have so many ways to control that cash flow with loan terms and controlling maintenance costs with a good maintenance team, and maybe it's another way to control on this.
I thought those were great. I wasn't even thinking about that. What you said, that very first one you said, is so powerful. You can control real estate by buying it at a discount, add in value to it. That's a huge one. And then you have the option, like you said, of either keeping it as a rental long term, or you can sell it. You got options. So many options with real estate. Controlling also gives you the option to decide what kind of tenant you want to put in.
Yep.
Some people like to do Section 8 tenants.
Yep.
Some people like more market rent tenants. You can choose that. You can go for a little higher end tenants by fixing your property up really nice, updates kitchens and baths.
Yeah.
Or you can kind of keep your maintenance costs down, your turnover costs down by just doing more of the clean and functional look.
Right. Yeah. So for you control freaks out there like Bryan and myself, real estate's the right investment.
I really love real estate because it's a physical asset that you can go see, you can touch it, and I always look at what are the other asset classes out there. Gold, I mean, you can see it, you can touch it, but you have no control over whether that's going up and down. You get no cash flow.
Yeah, that's a great point. And another way to control your asset, if it's real estate, is you can sell it and you can liquidate it and create a quick influx of cash. A lot of people say single family rentals aren't as liquid as say a stock, because you can go on the stock market and sell it. But in our realm, they are pretty liquid, so that's why we like to have that option to be able to sell them if we need to.
Yeah, and you can refinance it. If you've owned it for a while, you got it paid down well, and you need a little cash, you can just refinance it or put a line of credit against it. There's so many things you can do with real estate. Hey guys, we're going to talk just a little bit about some of the many tax benefits of owning real estate, and we're just going to cover the highlights on them here. We're going to go into a much greater detail in another video, but I'll start it off with, I think my favorite one is depreciation.
That's definitely my favorite. So in general, depreciation will be able to offset all of the rental income that you get from a property.
Yeah, so just so if you don't know what depreciation is, when you buy an asset like real estate, it's depreciated over a number of years. So it's 27 and a half years, which I know is going into the weeds on this a little bit, but bottom line is what Lucas said is right. You can realize that cash income in your pocket this year, but you don't have to pay taxes on it because that depreciation pretty much cancels it out.
Absolutely.
Huge benefit.
Huge benefit. The other benefit that we're going to talk about is capital gains tax rate.
So if you gotta go into work for a regular job like an engineer or an accountant or whatever, you're getting a W-2, you're paying a higher income tax rate typically than if you have an investment that you buy and you own for at least a year and you resell, like a single family rental. It's called capital gains tax rates. Right now, for most people, that's going to be either at 15 or 20%, where a lot of people's tax rates are going to be much higher.
Yeah, it's more on the lines of 30-35%. So you're cutting your tax bill in half if you sold your rental and made a profit on it.
Another great benefit is a 1031 exchange. So if you own a house as a rental house and you want to sell that house and buy another one, maybe a little nicer one in a nicer neighborhood or something, you want to upgrade your portfolio, you can sell that first house and exchange it into that second house, and you don't have to pay taxes on it when you sell that. That's a fantastic benefit.
That is amazing. That's unbelievable. One of the other tax benefits is now that you own these rentals, you can kind of treat your little rental company, little rental portfolio as a business, and you can start writing off qualified business expenses such as mileage that you're traveling to and from the rentals, maybe some office supplies that you're using for accounting, maybe a home office deduction, and maybe even meals and travel depending on what the current tax law says.
Another tax benefit we have here, and it's kind of, I don't know, maybe one that you don't want to think about too much, but when a real estate investor dies, the property that they own is transferred to their kids on what they call a stepped up basis, which means their kids don't have to pay for the taxes of that property selling, because it's kind of getting in the weeds here, but bottom line is it's a great thing to pass on to your heirs in a very tax-friendly way. So check out the stepped up basis if you're doing any tax planning or end of life planning or whatever you want to call it. And so these are some wonderful tax benefits, Lucas. We would certainly say we are not tax experts.
Yes, we are not. So we would recommend consulting with your local CPA to get the full benefit of owning real estate and all of its tax benefits.
We've used all 5 of these principles through our real estate investing career. And Lucas, what's your favorite one?
I would have to say my favorite power of real estate principle would be cash flow.
Cash flow? I like cash flow too. You know, I think compounding might be mine.
They're all my favorite, honestly.
Yeah, tax benefits pretty good too.
Yeah. Why don't you guys comment below and tell us what your favorite power of real estate principle is, and also hit that subscribe button for us if you enjoyed what you saw. See you guys later.
I think leverage might be my favorite principle.
That's a good way to end.
Yeah,
I like
that's
that.
a good one. That's
That's
a good
gonna be
ending.
good. Yeah.
Number 5, I can't really see what that says.
That's all right. I mean, that's why we cut. Number 5 is control. It's not very-
Control, okay.
Yeah. It doesn't have to be a one take. Yeah.
Yes.